Hello, everybody. Thank you for checking in. My name is Mark. I am the stock market jobber. Um, and the reason why I'm putting out this video is because I'm kind of on a mission here. Now, I spent 2 decades plus in the institutional trading world where I traded big size, yada, yada, yada. I traded directly for Mary Gabelli. I traded directly for Steve Cohen, two of the greatest in the history of the industry. I was also the head of trading at three different money managers where I oversaw various trading strategies. And yes, everyone's like, oh, did you know hedge funds? And it's like, okay, yes, I did oversee probably the trading of about 10 or 15 different hedge funds of all different strategies and styles. If you want to learn more about hedge funds, just check out our site, stockmarketjobber.com, and go to lessons, and you'll see where I do educational session on what are hedge funds, what are dark pools, what are algorithms. But anyway, let me just step into the present here, and I want to talk about technical analysis because it's so misunderstood and there are so many misconceptions, and I completely understand why. And if you're listening to me right now, I totally understand why. And the reason is like 90% of the people that are out there talking about it just have no clue. And since I started our YouTube page, or we started our YouTube page, which you need to subscribe to, right? Stock Market Jobber YouTube page. Please subscribe. Um, it's just there's so much misinformation out there, and I kind of get offended because it makes my profession look bad. So I guess I take it a little bit personal. But anyway, there's always people pitching this garbage like here's a Fibonacci lesson, here's an Elliott wave lesson, here's a harmonic chart lesson, blah, 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 blah. Well, guess what? In the institutional world, no one looks at that stuff. And I could say that with 100% confidence because I was there for more than 2 decades, longer than I care to remember, actually. But when we're looking at a chart, okay, like here we have, I'm going to show you guys a bunch of stuff here in 5 charts of ETFs, sector ETFs. So when we're looking at a chart, what we're really looking at is a illustration of human psychology and supply and demand. And that's it. It's not astrology. It's not reading tea leaves. Now let's just take a look at this here. This is our energy sector ETF. Notice how we hit resistance around 94 and then a good 4 months later, we hit resistance at the same level. Resistance is a large concentration of sellers or investors who are trying to sell around the same level. So when a market's moving higher, there's not enough supply to fill all the demand, or there's not enough sellers to fill all of the buy orders. So buyers are forced to decide to pay a premium, and that forces an uptrend. When we get to resistance, it's a little different. There's all of a sudden, for some reason, the sellers come out of the woodwork and they can satiate all of the demand and the price stops going higher. So we could see here resistance became resistance. Now you might say to yourself, well, gee, Mark, why would a level that was resistance become resistance again? And I just want to emphasize in the institutional world, the good traders focus on levels, trends, and momentum. And that's what we talk about at Stock Market Jobber. Well, there's probably some people who bought up here who, once the stock went lower, or the ETF in this case went lower, they tell themselves, man, I made a mistake. If it gets back up to my price level, I'm going to sell it because I want to get out of break even. That way I can, I made a mistake, but I can get out of it without a loss. So we have remorseful buyers placing sell orders at the level that was a former peak. We have something else, which is the opposite dynamic. The same thing, buyer's remorse can turn support into resistance. There are people who bought here, this is the 88 level, it went down and it became resistance. Then it became support. Now we can't take this stuff for granted, right? It's like this is the energy sector. It's worth trillions of dollars. Yet somehow all the forces of the millions of traders and the zillions of commodities and this, that, and the other thing form a perfect support level, which converts into kind of a really well defined resistance level, which converts into a really well defined support level. Buyer's remorse. People buy, the price goes lower. They tell themselves, I want to get out if I can at break even. The price goes higher, and all of a sudden there's a lot of sell orders at the same level that was support. Finally, we break through and we come down, and guess what? There was support. Seller's remorse. A lot of the people who sold there regret doing so when the price moves higher and they place their buy orders at the same level that was resistance. So levels that were resistance can become support because of seller's remorse. Now look at this here. Again, this is an industry that's worth like trillions of dollars, and no academic can explain this. Um, but as traders, we understand it because academics think about random walk theory and all this other garbage. But anyway, guys, listen. If you're listening to me, forget about Fibonacci, forget about Gann theory. Don't sign up for someone who doesn't have much experience and they know what they're talking about. You know, stockmarketjobber.com, and I'm glad you're here. Anyway, let me go back into this. That's just the marketing people telling me what to do. So anyway, resistance becomes support. You can really see it here clearly. You don't need to be a stock market guru to see that resistance becomes support. You could walk up to anyone on the street who knows nothing about the stock market and be like, "Wow, do you see that this particular level of 83 is important for this security?" And the answer is yes. Now this just shows us that how important the psychology is to the market. Now we talked about support becoming resistance because of buyer's remorse. There's an old saying on Wall Street, and it's totally true, and it's that gaps refill. A gap is when something closes at one price and opens at the next price where there's no trading. Gaps refill. Notice how we have a gap down, we have a gap up. Now you can understand that if you understand this concept or dynamic of support turning into resistance. Support can become resistance because of buyer's remorse. If the stock never trades there or the ETF never trades there, well, you're not going to have a lot of buyers because it didn't trade there. As a matter of fact, you're not going to have any buyers. So you're going to have very few amount of seller orders on the way up. So you gap down, you gap up. All right, I think I'm kind of done with this chart. Let's go to the next one. Again, we could see kind of the same stuff here, right? Let me just get my pen up. Resistance becomes support. Support becomes resistance. Support becomes resistance. So markets don't go in straight lines. They go in a series of trading ranges. It's like a staircase. And the trading range top is the bottom of the previous trading range. All right. So it's all about levels, trends, and momentum and psychology. So that's what we teach at Stock Market Jobber. Resistance was resistance. For some reason, some levels aren't important. I don't know why. Some levels are important and some levels aren't. But you don't really have to know why. I mean, sometimes it's obvious why a level is important. If it's $100 or $20, it's psychology. People like to buy at nice round levels. And sometimes we know a level is important support because it was resistance. But, resistance because it was support. It's important resistance because it was support. But a lot of times we don't know, but we don't need to know. I mean, do you really know how electricity works? I mean, seriously, ask yourself that. But if you flick the light switch, it comes on. At least that's the way I look at it. All right, so let's spend a minute here on patterns. Now, I don't really teach a lot of patterns because I think a lot of them are just kind of bogus or not legit. But when a stock is under, or an ETF or a financial market, I kind of just default to stocks, but it's the same for crypto, for whatever it is you're trading. When a stock starts to make the price differences or price changes that come with a potential reversal, it illustrates itself, or it becomes a graphical illustration on a chart. Now, let's talk about reversal patterns. At stockmarketjobber.com, we talk about head and shoulders, V-tops, and rounded tops, and that's pretty much it. We don't talk about double tops or triple tops because hopefully you're going to catch that first reversal. By the time the pattern plays out, traditionally, it's going to be, most of the gain is going to be lost. But anyway, here we got the Bulls, the blue team. They're in charge. Now, within just a matter of days, the red team or the Bears takes over. On a chart, this looks like something that's an inverted V. Pretty simple. This is a quick trend change. When we have a trend change where the blue team is in charge but the red team slowly takes over, it shows up on a chart as a rounded pattern. Here we have a rounded top. And now it looks like we broke support. Now, like we said, support is a large collection of buyers. When we break support, it's not symbolic. It just tells us that the investors who are creating the support with their buy orders have left the market. They're either done with their orders, they've canceled their orders. Regardless, it doesn't matter. Anytime you take demand or buyers out of a market, it sets the stage for the sellers to have to push the stuff, whatever they're selling, lower. They have to offer things at a discount to get interested, to get buyers to become interested. So quick reversals. Sorry, I'm just getting my pen up here. Quick, I can't even find it. Pen. Oh, there you are. Okay, so quick reversals manifest themselves on a chart as a V. It's not magic. It's not astrology. Slow reversals manifest themselves as a rounded top. And the same rules go for the bottom as for the top. Once again, we could see what I was talking about before. Resistance becomes support. Okay? Support becomes resistance. Support becomes resistance. Here we have what we call a reversal day. This is a day where the trend changes within one day, hence the name reversal day. So the red team's in charge. All of a sudden, on one day, the Bulls turn things around. Now, if you were to look at this in the morning of this particular day, you would have thought it was going to be another red day. All right? The blue candle is where the closing price is higher than the opening price. The opening price is the bottom of the candle, the close is the top. So this is a one-day reversal. It's called a reversal day, right? Makes sense. So here are some patterns, right? When things make an abrupt change in one day, we get a reversal day. When things change in, a couple days or a week or whatever, we get a V-top. If it takes a few weeks to reverse the trend, we get a rounded top. So that's what patterns are. They're just graphical illustrations of the changing dynamics. And a lot of people out there who think they know what they're doing or proclaim to know what they're doing, they don't understand these basics. It's not important to remember what the names are. It's important to remember what the pattern is showing you about the supply and demand dynamic. Every chart needs to be viewed through the prism of supply and demand. Now here we can see again, resistance becomes support, resistance becomes support, support becomes resistance. But let's talk about momentum. Now momentum is how far a stock or a security or a market has moved in a given period of time from time point A to time point B. If something gets aggressively bought, it gets above what is its traditional or typical trading range. Most stocks spend most of their time, or I keep saying stock, but it's any market, any financial market. Most stocks spend most of their time within their historical or typical trading range. If we get above that, we call it overbought. If we get below that, we call it oversold. Now, the reason why this is important is because if a market gets oversold, there's a good chance it reverts. If a market gets overbought, there's a good chance it reverts. There's a lot of, man, I can't find this damn pen. There's a lot of investment strategies on Wall Street that are based on this concept of reversion. So down here we have the relative strength index. Now, I only pay attention to a few indicators. Doesn't mean that they're better than any of the other ones. I like looking at relative strength index. I like looking at Bollinger Bands, and I like looking at some of the DeMark stuff. Now, it's not better or worse than anything else. There's 100 different momentum indicators or oscillators, whatever you want to call them. You need to find something that fits your eye. Everyone looks at things differently. Now, these things have been really good for me, and maybe you want to start there, but don't kind of pigeonhole yourself into just what I do or whatever. Look for an oscillator that you enjoy. A lot of people like stochastics. A lot of people like moving average, convergence, divergence. Here's the thing: they're all different ways of measuring the same thing, right? They're all ways of measuring how far something has moved from time period A to time period B. Now, all right, where is okay? There we go. So now here we have uh, this indicator on the bottom, the RSI indicator. When this blue line gets above this red line, it shows overbought conditions like here. Now, look at this up here. It was the perfect time to sell when we got this. And we see an exhaustion gap here. Gaps are also part of psychology. When there's an expression that gaps refill, and it's true. Now, when something gaps up, guess what? There's no one who bought it there. So you're not going to have remorseful buyers trying to sell stuff on the way down. So gaps tend to refill. But when things get really overbought, it's time to pay attention. When things get really oversold, it's time to pay attention. Oversold stocks that get to support tend to bounce. So if you get anything out of what I'm saying today, just remember that. Oversold stocks that get to support tend to bounce. All right, final thing here about our quick technical analysis lesson. We could see that support became resistance. Now there's a question, will this be support again? We got overbought, okay, overbought while we hit resistance. Overbought stocks that hit resistance tend to sell off. So if you have a stock and you thinking about like, I need to sell this, but I don't know where, well, if it gets to a resistance level and it's overbought, that's a good time to sell. May not be perfect, but it stacks the odds in your favor. And we have a gap that refilled. Remember, on the way up, there are people who a lot of times there's support because investors who sold want to buy their shares back. When something gaps up, it doesn't trade there. So there's not going to be anyone who sold to buy it back. So now we're back down to support. Resistance becomes support, and we'll see. All right, everyone, thank you. Make sure you subscribe to stockmarketjobber.com on our YouTube page here, and please make sure you check out our website. And I am Mark, the Stock Market Jobber, and I will see you soon. Thank you, everybody.